Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with Jared Glansbeek. Jared founded RisCura in 1999, and it's a global investment management firm. He is now CIO of the firm. Previously, he was executive director at two asset management companies and a consultant on emerging markets. We're here today to speak about RisCura's view of the overall markets, global markets, and some of the frontier markets, but I'm hoping also we can get Jared to talk a little bit about LDI, as we believe he was one of the first people to address risk directly to LDI. So Jared, thank you for being here. Could we start with your firm's top-level views of the global outlook, please?
Okay, so I guess the starting point for that is, you mentioned LDI, is we can't have any view unless we understand what we're trying to pursue for a client. And that really is about, there's a set of cash flows they need to meet that go out N years, and what we have to do is we have to discount that and we have to compare that then to some set of assets. So that's always the starting point, and a short-term insurer would have more cash and someone who can take more risk, like a pension fund, would have more equity. And the reason that's important is we can only have an outlook relative to what a client can actually put in their portfolio. So barring that, and I want to take that out, I guess the first thing for us is that the inflation and geopolitical stories, I think this is a common theme. They are not sorted yet. We're still in that morass. We're still trying to get out of that. And that's where it's interesting. What's interesting about that, though, is as an emerging market specialist or emerging frontier market specialist, we haven't really had a period where there hasn't been inflation. This is not a new occurrence for us. This is what we've had to deal with forever. And it's raised some interesting things, which I think, by the way, in the developed market, people are starting to consider and contemplate. So, for instance, when you've got high inflation, what does that truly mean for earnings in a recession? You can still have earnings going up. You've got the inflation, and if some of it's passed on, you can still see earnings. And it's how does that impact the calculation? And obviously, then, in an LDI, or by the way, relating that to assets, ultimately any asset you buy is a strip of cash flows, you're discounting it. So you've got to build in that growth, and then you've got to say, well, what are they worth today for the asset? So with respect to that, I think if we're looking at a global view, certainly when you're looking at emerging and frontier markets and you're looking relative to interest rates in those markets, they actually don't look that expensive. Now, there are some issues around all these markets, and there are cheap markets and expensive markets. But just with what the dollar has done over the last, let's just kind of conservatively say 15 years, these markets are actually all cheap, and they've been cheap for a very long time. So these other markets. And as you know, if we are contemplating a portfolio relative to some long-term strategic asset allocation, we're going to be principally concerned with relative weightings of DM versus EM in a portfolio. And I would suggest in that debate that we would probably, and there's a timing issue in it as well, but we would probably then say we want to be overweight those cheaper developing markets. And that can be in fact, I'd be quite specific and say that in terms of the entire capital structure, we'd still have the same view. So prefer fixed interest there, or fixed income, prefer their equities, and in all of these areas would be more overweight those than a traditional portfolio.
Okay, and the timing issue you just mentioned, could you elaborate on that a little, please?
So with the capital flows and liquidity, you see pricing change a lot. I mean, if you go down to, and in a frontier market, you look at, let's say, the African markets, less liquidity and yields of countries which have got very low debt to GDP, kicking up to 14% in dollars, when the locals say that this is not, in their sense, a Turkey scenario, because they just don't see their countries defaulting at all, yet you can get 14% dollar-denominated income. I mean, it's extraordinary. So, and the locals will say that. Now, when we look at it at a distance, and let's say in Wall Street, you're looking at Kenya, you have no clue. And you say, like, why would I do that? And the Kenyan is saying, I'm going to buy my own bonds.
Right.
I mean, and I think there's been quite a lot of that. So it's that local knowledge versus foreign and local comfort that's been extraordinary. And there are unbelievable opportunities. Now, is that opportunity there for a 200 billion asset manager based in Wall Street? There's a liquidity issue around.
Yes, of course, yeah.
And so you've got to size these things properly. But in sizing, what we theoretically what we believe in is we prefer diversification. Now, the one thing you spoke about, LDI, I think for many years, certainly prior to kind of the late 1990s, everything in our investment markets was built around Markowitz. And the Markowitz it was a great starting point for understanding how portfolios should be structured. But it really lacked when you started to say, well, is risk-free appropriate? And more importantly do we invest for one period?
Right.
And that's been the interesting thing, in which case, when you start to get into that, you start to realize that actually it's okay to put 0.2% of something in a portfolio, which is a fairly big portfolio, because it adds to return over multiple periods, and it also subtracts risk, which we all understand through markets. And so it's actually quite an interesting thing where you end up and you say, actually, I like the diversification. It actually makes sense, even if it is small slugs, because there's a liquidity constraint.
Yeah, that's. I remember those times in those debates, and those debates became more rancorous as a few years passed. When the risk-free rate was a bond that was issued by a country that kept pushing its own debt limit. Made you wonder about exactly what we're doing here. So that is fascinating. So you did give me a lot of places to go sort of down from here. No, that's right. No, this is exceptionally helpful. And I haven't thought about Markowitz in a while either. I did read in my prep for this, you all have a very interesting sort of China newsletter that covers the region. And it raised a very important question, I thought, about the sort of ESG setup and the focus on the E. And the Adani Group crisis may have brought light to the idea that we spent a little bit too much on the E and maybe not enough on the G in some markets. Could you expand on that?
Can I take a step back on that?
Sure.
I mean, I hear you, and I think that's important. What we found, so I just have to preface this with what we found in these markets, because especially the developing markets, what you find is that the worst case scenario for a citizen in that country is they can't put food on the table. So it's quite a different scenario. And, you have that problem here, but you don't have 50% unemployment problems, et cetera. So it turns out that actually when you're saying ESG, it turns out that when you convert what those countries believe in terms of their own growth plans on ESG into the SDGs, turns out that actually that the S component is actually the most important. And the E and the S are all governed through the G on listed assets, because that's kind of where you express it. Even though E and S are important, even in your engagement, most of the work is done then in G. So that's the first comment I'd like to say. The second thing that's important is that it is emerging markets. And even if you don't worry about E, S, and G, you got to recognize that these are markets where alpha is available. You have to take bets and things go wrong. And in that, then coming to the G is you would want an active manager, or you'd want someone active in every sense to be actually looking at that portfolio, because, by the way, they're inefficient anyway. So then you get to really the G in a number of scenarios. So you've got the Steinhoff. You've got, so it's not actually, and that obviously came through really Europe, but it was originally another emerging market company. But all of them, these things can go wrong. They can go wrong in India. They can go wrong in South Africa. And sure, they can happen in developed markets, but you just have that big risk in these markets. And we've seen it time and time again that you have a report coming from someone who's done a lot of work. They may be right, they may be wrong. It depends on how believable they are, and then companies die because of that. And it's usually some, as you saw, it's a short seller coming up with some view, and it has credence, and so the markets really slaughter these stocks. So I would just suggest that is the normal course of events where you can get overvalued stocks, and you can have these kinds of things actually happen. And it just doesn't feel that unnatural, because, by the way, you have to be so specific about the human resources you employ in these markets to be managing your assets, that G is something you would want them to be looking at very strongly.
Yeah, and I would add, I'm glad you said this, because probably one of the more spectacular developed market failures of G was Wirecard. And now I also think there's a lot of discussion about, well, that wouldn't have happened in the US. Well, of course it would. It might have been a Bitcoin company.
Well, maybe just one other point. You can decide how you feel about China.
Mm-hmm.
And the ESG comes up on the Chinese issue all the time. But what's interesting is when you speak to, because what you'll also have seen is we've issued a report on China. What's interesting is that those asset managers, those active asset managers, they have no interest in their holdings being sanctioned.
Right.
And so, people get upset and there's a government issue, but when you talk to the asset manager, he's interested in his carry. And he knows that the one thing he can't afford is a torpedo. So it turns out there's actually a lot, the SOEs aren't really supported by those active managers that you may employ. And it's just interesting for me that these things find their answers despite, let's say, the rhetoric that we generally, hear and believe in.
Yeah. One of the things that I found amazing was a couple of years ago, the advances that some of the wealth management companies in China were making technologically was like nothing we have in the US. I mean, it was mind-blowingly good.
Well, Africa is a great example. It's so far behind everyone else that actually you're finding they don't need a Bank of America branch on the corner. They've gone straight to the phone.
It's incredible. Yeah.
It's just been this leapfrog.
Yeah.
And you're seeing VC in these markets just blow out. So you saw VC prices, or let's just say VC and tech prices have really suffered over the last year or two. Mm-hmm. Interestingly, you haven't seen that quite happen in Africa where things are still being supported, because actually that is the very next step, no matter how you choose to see it.
Right. Now, there are some macroeconomic things, positive wins that are happening in Africa also. There's some a serious improvement in trade. There's some attention that the continent got. How do you all see all that stuff from a macroeconomic perspective on the continent as a whole?
Obviously, all positive. And what I would add to this, if you go and look at most commodity prices, and you look at over the last 7 years, the price today is significantly higher than it was 7 years ago. Sure, it was higher before that. Now, when you are a company or a country, if you like, earning revenue out of these things, it turns out that in an inflationary sense, you've had a nice boost, your revenue looks better, and so the situation looks better. Turns out that when you are an investor, we're worried about year-on-year inflation growth, and that may be quite different. So we may be, for now, in a place where you start to see that pressure on inflation, and maybe it's turning. You can see the markets are struggling on a year-on-year basis. But when you go and look at these countries and companies, actually they're sitting, they haven't had it this good. Sure, it's down. Sorry, it's down 10%. But they'll live with that because it's up 30% from where it was.
Right.
So I would add to what you said, you have to throw in the commodity prices. It doesn't affect everybody equally. And I would say the free trade will take some time to develop. So I would think it's still a bit early on that. But you just monitor what prices in these markets have done more recently, and they look interesting. What you've got to do, though, when you're entering, and this is all frontier, and as you know, emerging markets, if you look at, for instance, the frontier benchmark, it's got zero tech.
Right.
It's got 30% Vietnam, of which 12% is property.
Right.
So there's some specifics. And the reason I say that is when you look at listed Africa, it's got what you'd expect. Big capital, and I would say kind of politically influenced companies. So your telecoms, your banks, and mining. That's what the listed market looks like.
Yeah.
So unfortunately, to fill the holes, you have to then look at what's happening on the private capital dissemination. And that there starts to look really interesting, because you start to put these together. You have to weight them properly. You have to fill in the gaps so that you can do things properly. There's also regional stuff happening. I mean, you say Africa, it's 50 plus companies. It's countries. It is. There's francophone. There's you have every language.
Right.
You have religious issues all over. Right. You have the general east, west, north, south. I mean, you really have a lot going on, and so it actually is. It's more complex than looking at the 50 states of. Yeah. It's just far more
the 50 semi-sovereign states of the U.S.
Exactly.
Yeah.
And what's interesting in that, if you start to say, look, I want to capture some level of alpha and, let's say, beta in that market because it's priced cheaply, etc.
Right.
You start really have to start looking at kind of how you put those portfolios together, because it's just not that simple. It's not the approach of, look, let's go and get 2 developed market managers. That is just not going to cut it. You have to cross asset class, you have to cross managers, you have to cross regions, and private, public. There's really a lot that you need to do to actually try and capture that opportunity with safety.
Yeah, I think we have a series of events here called the Asset Owner Series. We regularly have exceptionally large pension plans, foundations, endowments, family offices, et cetera, all of whom find this market very, very interesting, but also very difficult to access because of the issue you mentioned earlier, is their minimum allocation would be the entire market. So how do you see that evolving over the coming years?
So, I mean, the first thing I want to point out is that the binary look at whether you should be investing or not is not actually what we do. And even if you looked at an asset manager's equity portfolio, you'd find something in there at 0.1%. Mm-hmm. Yet, when we think of it at this level of governance for a fund where you're hiring teams, we have some cutoff and it just seems strange. So I would just suggest that it is the kind of thing where if you put 1.1% in your portfolio and it doubles, it's the same as having 1% and it does the more pedestrian 1%. So it's an incredibly useful way of enhancing return. Also, I told you before, if you structure portfolio well, then the diversification helps long-term compound returns.
Right.
And so I would just suggest that these plans have these cutoffs. I just don't think. I'm not sure. Firstly, I can tell you that theoretically they don't make sense.
Right.
And then if you can get past that, because practically they do, mm-hmm. you maybe don't want to do something. And then the last thing I can say is what you generally have to do is those, if I may, prejudices against portfolios which are composed of multiple service providers. Mm-hmm. I'm being pedantic about that because I don't want to say fund of funds and I don't want to say, but I'm just saying where you contemplate that kind of thing, it's generally those have to be the answers. And it by the way, it has to happen in emerging markets pretty much as well as, we're talking Africa, but it has to happen in India, it has to happen in China, it has to happen in Africa, it has to happen in frontier markets. I mean, frontier markets are, if you want to use regional specialists, it's a mess. I mean, you've got Africa, you've got Vietnam, you've got Eastern Europe. It's just, you've got Middle East. There's just no commonality in this, and then you've got the flaws of the ultimate benchmark. So I would just suggest that on these you have to start saying maybe I do need to look at a slightly different way to make sure that if I am putting 0.2% of my portfolio in this, it is well managed anyway, and it may not be me going for 0.2% of my portfolio and hiring 10 specialists, which just it's too much governance for that component. That should be outsourced.
Wow. Oh, great.
I'm sorry.
No, that is wonderful. Thank you. We've so far been to Around the World Twice, Markowitz. This is the greatest podcast ever. So thank you, Jared, for being here and joining us. And thank you to the listeners to CFA Society New York's podcast, Compound Insights. Until next time, I'm your host, Rob Rowan.